What's going on, Scott? You, it is Christos here on December 13th, 2018. The Bears have them down slightly, 0.28% there. And visually, if you zoom in, we're hanging just around the lows from yesterday. That's basically where we've been all day. We've gone a little bit below, we went back up, we go a little bit below, we get back up. And now we're kind of hanging just below it. Bears doing their best to obviously close below the low of yesterday as a sign of strength for them. And then what? Well, continue the market lower and obviously trying to break out from the bottom of this range. But you can see just how difficult it is when we get to the bottom of the range to break out, or the top of the range, right? We got to the top here once, twice, three times, still couldn't break out. Same thing on the bottom. But if you kind of take a closer look, look how quickly we get to the bottom in just 3 days from the high to the low here. And then what? Bulls buy. And then bears try again. And then bulls buy. And then bears try again. And it just creates this tug of war, kind of 50-50 probability on which side is going to win. But eventually one side does give up. But knowing which side and when they will give up is a pretty tough gig. Nonetheless, this is what we have right now, hanging out at the bottom of the range, and some interesting tug of war between the Bulls and the Bears these days. Today we had one closing trade in IWM, and here I have the trade history for it. You can see we made a good percentage of our max profit here, over 50% of our max profit, and doing so in less than 25 days here. So a pretty nice trade. Here's the opening order. It was a broken wing iron condor, right? 5-point wide call spread, 1-point wide put spread. If any of that confuses you, just go to the trade review video from November 19th, 2018, where we discuss or where we review this opening trade. And if you do that, or if you're familiar with it, you know that we collected a credit larger than the width of our put spread. That means no risk to that downside, and we could actually make money to the downside. The difference between the credit received with the put spread, that would be 3 cents, right? So we can make 3 cents no matter how low IWM goes, but you can see we made a lot more than 3 cents on this trade. So why is that? How is that? Well, it's probably because price is trading right between or somewhere between our short strikes. And our short strikes are the 158 short call and the 137 short put. So if we go to the chart of IWM here, you're going to see that is in fact the case. It's trading for around $143 per share, right? And if we zoom in, we can kind of check out the life cycle of the trade. We put the trade on November 19th, right? So November 19th is somewhere in here. Where is it? There it is, this day here. And what was it? The 137, 159, I believe. Yep, short the 137 put, short the 158 call. So 137, 158. So 158 is somewhere up here, right? You can see it kind of tried to test it on the upside. And then 137, not quite there on the downside either. And if we take a look at what volatility did, well, here's where it was on 11/19. Look where it is today, approximately the same level. So this is really just classic time decay going by, price staying within the range that we needed to, and it's actually near the lower end of the range, right? Price is much closer to 137, which is our short put, than to 158, which is our short call. And since we have no risk to the downside on this trade, the position likes it when we're kind of near the downside, right? It likes it more than if we were near the upside. So as a result of that, which is basically direction, and as a result of time going by, which is theta, those two things are what are giving us our profit here, even with volatility staying constant. So this is a pretty good example of how catching that high tick in IVR isn't always the most important thing in the world, because as premium sellers, we can get paid in more ways than one. We can get paid with price staying within our range. We can get paid with time simply going by, right? 25 days of time going by. And of course, we can get paid with some volatility contraction as well. But we really only need one of those things to profit. And if we have two or all three of those things, well, that's when we can take positions off much quicker, much faster, in a much shorter time period, right? But typically, we're taking trades off in around 21 days or so, or at least the winners. And this was a classic trade of around 24 days, I believe, exactly. And just a good example of how catching that high tick in IVR isn't everything, but time going by, as well as price staying around the area you need it to, that is really all you need. So a nice trade here and pretty straightforward, I think. Of course, you can chat or email us with any questions that you have. But I think that is about it for this one, guys. I thank you for listening. I hope you learned something from this. And until the next video, take care.